Hello, accounting superstars. This is Professor Don Bush. I've been teaching accounting now for about 30 years and have been a CPA for about that long. I've got a lot of fantastic ways to explain accounting and make it easy to understand. So let's get rolling this week. So here's what's happening. We're working with When We Get to It Construction, the construction company that you don't want to have work on your home. And we're accounting for pensions. And this is the example number 4, which means there are examples number 1, 2, and 3, which if it were me, if you haven't seen those examples, go back and watch those videos first, because as we proceed through these examples, the examples get a little bit more complex each time. So you want to start out with the easy example first. So go back to example 1 and we'll catch you when you're all caught up. So what we're doing is we're using a pension worksheet. Now this is not an official accounting record, but it's just a tool to help us figure out a journal entry, which is right down here. Here we go. This journal entry here, where this spreadsheet helps us figure this out. So what's going on this week is we're adding something. It's called prior service cost, and I'll explain it in a moment here. And what we're doing is we're placing the debit in other comprehensive income, prior service cost. So what the heck is other comprehensive income? It's something that's not stressed very much in accounting education, but it's something that's important. And it's something that I personally don't care for. If it were up to me, if I were the person making up accounting rules, I wouldn't have it at all. So what is it? Other comprehensive income. Well, other comprehensive income are items, specific items that the accounting profession, namely FASB, has determined that should skip the income statement, just not go on the income statement at all. And that's why I don't like it, because I believe that it's misleading to investors and owners and people who may not really totally understand financial statements. I think it complicates things and it sort of hides things too a little bit. So this prior service cost plan amended, you would think it would be right over here under pension expense, $5,000 debit, but instead the accounting profession has determined and decided that it's much better if we skip the income statement altogether and go straight to the equity section of the balance sheet and call it other comprehensive income, which most people don't understand. So what's going on is it's making the income statement look a whole lot better than it otherwise would. And you might say, well, why did FASB do this? Why would they do such a thing? Well, most accounting rules and regulations are based on logic and reason, and a few times accounting rules and regulations are based on politics and trying to keep everybody happy. So sometimes accounting rules and regulations don't follow reason and logic. And I believe, this is my own opinion, I believe this is one of those examples. So going on here we go. Let's see how this works. Well, on the left-hand side, we have items. And these are all the things that happened during the year, and I've got a couple of them highlighted in yellow, and they are related together, and they're brand new for this lesson. And in the middle here, in the blue area, we have numbers that are going to help us formulate the journal entry down here. And of course, we're introducing this other comprehensive income. These are items that skip the income statement. And over here, we have a memo record. We have projected pension liability, pension assets, and this represents what is going on with a third party, the people who are in charge of safeguarding the pension assets and investing the pension assets and paying out pension benefits to workers. So this is an independent third party. And as I mentioned, this is not an official part of the accounting records, but it's simply a tool to help us figure out this journal entry right down here. So let's get started. Here we go on the balance here, January 1st, 2004. We have over here the projected pension liability, $15,403 credit. and pension assets $14,500 debit. And you may notice that the pension assets are not as large as the pension liability. So that means the pension is underfunded, which is not a good thing, but it's very typical with pensions, especially with the state and local governments. And this 903 is simply the difference between the projected pension liability and pension assets. If you were to subtract one from the other, you would get 903, and the credits are larger, so we're calling this a credit. And this tells us right here that the pension is underfunded by $903, and this goes on the balance sheet of When We Get to It Construction's balance sheet. So moving on, well, this prior service cost plan amended, what is that? We're debiting it for $5,000, which relatively speaking here is a lot of money. And what it is When We Get to It Construction negotiated with its workers, and they came to the agreement that workers who have worked for When We Get to It Construction for the last 5 years, for example, are going to get increased pension benefits. And so we call this a prior service cost because it's based on the past, and they're saying moving forward, you folks that have worked for us for the last 5 years, you're going to get a larger pension than before. And of course that made the workers happy, and so When We Get to Construction needs to include this in its accounting records. Now, they determined the amount that would be appropriate to debit and credit to be $5,000. And this is an estimate based on actuaries. Actuaries are people who are very good at math, statistics, and they help with probabilities and figuring out the cost of the pension. So these actuaries said, you know, we think that we probably will have a prior service cost of about $5,000. So that's what we're doing, $5,000 debit, $5,000 credit. So this $5,000 debit is going under other comprehensive income, prior service costs, which means it's bypassing the income statement. So what we do is we immediately come down here and we come up with a new beginning balance. So this adjusted balance January 1st, 2004, that is going to be the brand new balance. And so all we do is take our $15,403, add 5,000, bingo, there you are, $20,403. And we bring down the $14,005, and there we are. And you might say, hey, why aren't we updating this pension asset liability? Well, we will, and we'll wait until we get down here to the bottom to update it all. It will all work out. So letter A here, the employee service cost, $4,800 debit. This means that our employees have worked, they've earned money during the year, they've earned pension benefits, and they are determined to be $4,800 debit, and so we put it under here, projected pension liability, $4,800 credit. And again, everything in green here is a representation of the third party pension trustee. Letter B, employer contributions to plan. Well, the employer, when we get to construction, sent to the third party $4,000 cash. So we credit cash for $4,000 and we debit pension assets by $4,000. And you can see When We Get to It Construction is not fully funding their pension. So down the road, they may get into a little bit of trouble for this. Interest cost. Now we're using 5% of the beginning balance. Why 5%? It's just a nice round even number, but that percentage would have to be determined with the help of the actuary. So 5% of the beginning balance. So you might say, well, what beginning balance? Well, let's use this updated beginning balance here. So 5% of $20,403, and you get, rounded here, $1,020. So we debit pension expense for $1,020. We credit projected pension liability by $1,020 credit. By the way, you want to make sure that your horizontal lines always balance, with the exception of this one here. and this top one. They don't have to balance horizontally. Letter D, actual return on pension assets. What's going on is the people who are running the pension, the third party here, they've got all these pension assets, and they did a good job investing those pension assets, and they made a return. And what that does, it reduces the burden of the pension expense on the employer, because these assets are earning a return. So we have $1,000 credit, we're reducing the pension expense, and we're increasing the pension assets that are in the hands of the third party. So $1,000 debit, and it balances horizontally. Benefits paid to workers. Now this is coming out of the independent third party. It reduces the pension liability, it reduces the pension assets, so that's why we have $3,000 credit, $3,000 debit. And coming down to letter F, amortization of prior service costs. So what we have here is these two are related. The prior service cost, plan amended, and the amortization prior service cost, they are related, and that's why I have them highlighted in yellow. So FASB, the people who make up generally accepted accounting principles, they determined, well, we can't have this other comprehensive income of $5,000 sitting here on the balance sheet forever. What we need to do is amortize it. So instead of having this $5,000 as a pension expense all in one big giant lump sum, which would make the income statement look horrible, well, what we'll do is we'll amortize it over small amounts. So what's going on here is they're amortizing it by $500, so they're crediting prior service cost, other comprehensive income by $500, and we're debiting pension expense. So to put it all another way, this $5,000 is eventually running through the income statement, but in small amounts and over time. So here we go. So down to the journal entry. Journal entry, what we do is we total up the columns, and you have to watch out. Make sure you keep your debits and credits straight. So add up pension expense. We have $4,800 debit, $1,020 debit. So you add those together, minus away $1,000 credit, add $500 debit, and you end up with $5,320 debit. Let's add up the cash column, which is easy to do. $4,000 credit. Let's add up the other comprehensive income, prior service cost. And so $5,000 debit minus away a $500 credit, you end up with $4,500 debit. Over here, the way we figure out this $5,820 is we simply look at our debits and credits over here. We look at the $5,320 debit. We've got a $4,500 debit. That adds up to about $9,820 debit. We have a credit of $4,000. So in order to make this all balance, we need a credit of $5,820. So here's what's going on here. If you take that $5,820, add the $4,000, it should equal these two debits. So this horizontal line here has got to balance because it will be our journal entry. And coming down here to the end of the year balances, these end of the year balances are going to be the beginning of the year balances for the next year, year 5 in our final example. So all we do is look at the pension assets, and we're going to start right here with this $14,500, $4,000 debit, add to that a $1,000 debit, subtract a $3,000 credit, and you end up with $16,500 debit. Coming over here to the projected pension liability, we're going to start here with the $20,000 credit, add to that a $4,800 credit, add to that $1,200 credit, subtract away the $3,000 debit, and you end up with $23,223 credit. Now you look at the two and you say, hey, the pension liability is much greater than the $16,500 pension assets, and you find the difference between the two, and the difference is $6,723, and it's going to be a credit because the credits are larger. So what's happening here is this pension fund is severely underfunded. Just remember that our state and local governments are severely underfunded also, and it's going to be really big problems for those companies and governments here in the near future when they have to pay out all these pension benefits. So here's the journal entry, folks. It's very simple. We're going to take the journal entry right from our journal entry line right here. So pension expense, $5,320. Bingo, there we are. Other comprehensive income, $4,500. We get it right from there. Cash being decreased by $4,000. Get it from here. Pension asset liability, $5,820. We get it from there, and there you go. And on the balance sheet, as a non-current liability, we have pension asset / liability. This is a pension liability. We have $6,723, and we get that number from right there. So ladies and gentlemen, that is how we handle it. So what did we learn today? Well, we reviewed the pension worksheet, but we learned a lot about prior service cost and amortizing that prior service cost. And we learned about other comprehensive income, that these are expenses or revenues that skip past the income statement, go straight to the balance sheet. I don't care for them, but that's the way it goes. So anyways, if this video helped you out, let me know and hit that like button and subscribe to the channel. And that way I'll make some more videos for you. So I'll see you with example number 5, our final example. See you then. Over and out.